So I think we can all agree that 2022 was not a good year for the stock market. The majority of people that I spoke to are losing money and have not had a good year. And everybody's obsessed with one question, which is, where is the bottom of the stock market? When do we know it's time to jump back in and start increasing our positions? The problem is that nobody really knows, including myself, since my crystal ball is not here. So nobody knows. But I always been very, very consistent by telling you, the minute the Fed pivots, that's where I know. The minute the Fed pivots is the moment we actually have some clarity about where the bottom is going to be. It doesn't necessarily mean that the Fed pivot automatically sends the stock market for a 6-month rally. That's not what I've said. But I'm saying that's the moment where things starts to change. The problem is that we haven't had any kind of catalyst to show that the Fed pivot should happen soon, with inflation being at almost 8%, still 7.7%. With the war in Ukraine and Russia, with China lockdowns, with the price of energy, just everything seems to point to the fact that we're still far away from that potential Fed pivot. When we say Fed pivot, we mean a change of policy from a more hawkish stance, more increasing rates, more going aggressive against the market, into a more accommodating policy. Now, look, this is the first time I'm going to show you a clip by somebody with a credible standing in the community who comes out and says, hey, I actually am legit. And I think that the Fed will pivot in 2023, and here's why. Now, we're going to examine what Professor Siegel is saying here, and let me just clear it up right here before we start this segment that he's a former finance professor from Wharton. That means he knows what he's talking about. So whether you agree or disagree with him in my comment section, that's fine. It's okay to disagree with him. Everybody's entitled to their own opinion. But let's keep it in the back of our heads that this guy knows what he's talking about. So he's not some sort of a talking head, normal talking head on CNBC. He's actually a credible source. Now, I'm going to watch this clip with you. I'm going to hear out his argument, and I'm going to give you my honest, raw opinion into what he's saying here, whether I agree, disagree, and why. Most importantly, I want to encourage us to think together about this, and the best way to do it is to listen with it, go into it with a completely open mind, open heart, listen to what he has to say, and then analyze it on my end. Basically, I'm going to stress test what he's saying here, and I'm going to let you know if I think he's right or if he's wrong. Let's start the clip, and let's see what he has to say.
Joining us now to talk about this, someone who I imagine disagrees vehemently, but we'll see, Jeremy Siegel, Professor Emeritus at Finance at the University of Pennsylvania's Wharton School of Business. Take on Goldman Sachs. Jeremy, what do you say, Professor?
Yeah, I think Goldman is. I mean, I respect them so much, but I think they're being way too pessimistic.
I just want to clarify what you're talking about. There's a note from Goldman Sachs that we're heading into a worse position, the Fed is not going to pivot, and that the market is going into some serious bad times in 2023. And Jeremy Siegel is coming out saying, hey, I have a contrarian opinion to that, and that's why he's having this interview with Andrew.
Listen, it's taken way too long for the Fed to get it, and they haven't gotten it yet, that inflation is basically over, but they will, and I think they're going to get it maybe very late this year or early next year, and I think as soon as they get it, you're going to see a big increase in the equity prices.
So what he's saying here is that he thinks that the Fed pivot, that change of policy from hawkish to more dovish, from aggressive to more lenient, happens either by the end of this year, which is 40 days, or the beginning of next year, which seems more likely. And what he's saying here is that the moment that the Fed changes their policy, their stance, the equity markets will react instantaneously, because the equity markets, they price into the future. So if the Fed changes policy now, everything will get priced in accordingly, and we'll get a massive rally in the stock market. In the headline here, I think he said 20%. I don't really know, but that's kind of the argument here. Now, we haven't heard his reason or his kind of catalyst as to why he thinks the Fed will pivot so fast, and I'm assuming it's about to come up right now.
What makes you so convinced, though, that they are going to shift, given how Jay Powell has said, and we've talked about it on this show over and over again, this idea, it's a little bit maybe like an antibiotic. You got to go for the full 10-day dose. That on day 7, it may look like you're feeling better. It may look like it, but if you stop taking it, you could get sick again.
Well,
That's a great point by Andrew.
next week we're going to get the Case-Shiller monthly housing index as well as the federal index. Both are expected to show another big decline. And as you know, my point has been housing is declined, but the way the government computes it, and it's a very important part of the index, it's so lagged that it'll continue to show increases. And I think finally the Fed will say, you know what, on the ground, things are all declining, and we've got to think about that. But I was shocked when Jim Bullard said, just last week, I think things are getting worse, and now I feel I have to be even more aggressive.
He's referring to a statement that was made last week by one of the Fed governors. I believe that was the gentleman from St. Louis who said that things are getting worse and that the Fed has to go from 4% or 5% all the way to 7% just to tackle this current inflation. So Professor Siegel is saying, I have no idea what he's talking about. I don't know where he's getting his numbers. I absolutely do not agree. That's an academic way of him basically to call out this guy, say, hey, you don't know what the F you're talking about.
I mean, I really wonder what sort of data he's looking at. Tomorrow we're going
When he says, I wonder what sort of data he's looking at, is a nice academic way of calling him an idiot. Just my 2 cents. Maybe I'm wrong, but I had a lot of professors speak in my life, and that's professor speak for, dude, you don't know what you're talking about.
to get the monthly money supply, as I think I've noted. We've had
That's super important. That's the first time where I think he's making a valid point. Now, he talked about the housing market cooling down, and that's going to contribute to lower inflation for sure. But he hasn't addressed the big elephant in the room, which is still commodity prices because of what's going on in Russia and Ukraine, which is China still locking down, which means less production capacity in China, which means that winter is coming up, so energy prices will go up because of heating, because of everything that's going on right now. And if China actually reopens, then the flip side of that is going to be more consumption of energy. So without OPEC actually playing ball with the US here, which it isn't right now, these problems have yet to be solved. And that alone, the real estate market cooling down alone in itself, I don't think is enough of an accelerator to offset that. But this is where he's hitting it at the head. I think he's talking about money supply is coming down. Watch some of the old Milton Friedman lectures. Milton Friedman always said, and he's kind of the OG in the community, he's one of my favorite all-time greats. He's always said that the main thing isn't none of these supply chains or OPEC or none of this. Is money supply means inflation. Money supply is what decides if we have inflation or not. And I could not agree more. The moment you have more money in the system, people spend more, then inflation happens. We all saw that happen during the pandemic. So Jeremy Siegel is saying, hey, look, don't want to believe me on the real estate market, whatever. But the money supply is coming down, which will reflect in slower inflation, which will basically mandate the Fed to rethink its policy.
the greatest 6-month decline in the money supply since World War II.
Yeah.
I expect another decline tomorrow. So monetary conditions are still extraordinarily tight. Once they get to the recognition, hey, what's going up in the real world, they'll say, we just don't have to tighten anymore. And we don't have to get into the five.
Professor, we just had the CEO of...
He was about to say something super controversial, and Andrew interrupted him, which, let him speak, because he was about to say, I don't see them getting into the and then Andrew stopped him. What he was about to say is, I don't see them getting into the 5% area. So he doesn't even think the Fed will ever hit 5% interest, which is kind of the consensus right now. It's a very, very bullish stance on the market.
Smucker's on this morning. He seemed to be able to pass his costs on and then some to the customer base right now, right?
Yeah. I mean, there's certainly going to be pass-ons without any doubt. But when you take a look at the important part of the index, that housing index, which for the Fed is going up because of the way they construct it, in the real world is going down. 40%
Right.
of the core index is this housing. So even when you take into account passing on, and I think it's true, many of them have passed on, but now their commodity costs are not going up anymore. I mean, there's some labor costs going
Right.
up, but outside of that, I think basically 90% of our inflation is gone.
It's a very aggressive stance, especially as far as it goes with commodities. Don't forget that while the U.S. is kind of self-sufficient as far as energy, as far as food production, commodities mostly, and it has a lot of friendly neighbors that provide it, Canada and Mexico and whatnot. The price of these commodities is global, and it's set on a global marketplace. And globally, there's a big shortage because of what's happening with Ukraine and Russia. Not just commodities, raw materials, because of what happens in Russia and Ukraine is not in the position where you can say, well, this is over right now, and there's an absolute free flow of commodities and grains and whatnot. You have to remember, most of the world relies on Russia and Ukraine to provide them wheat and grain. Right now, that's up in the air. To say that 90% of inflation is gone, it's a very aggressive stance. I don't know if I would agree to that stance. I would definitely agree to the money supply situation. But let's keep listening.
Professor, boy, do I hope you're right. And I know eventually, no matter what, I hope you will be right. But the question is when you'll be right. And therefore, I'd ask, do you think we're talking about 50 basis points or 75 for the next time? Or something else? And then as you look out to 2023, how you think the Fed pivots? Because part of the, you just mentioned Jim Bullard saying he's seeing the opposite that you're seeing. Jay Powell has talked about, just his own credibility. The question is, there will be a pivot at some point, but also there's a bit of how do you pivot when you start to think about those other kind of issues?
Well, I think the most important thing, I think it's looking to me like 50 basis points, because I think the data will still come in on the softer side. What's more important in that December 14th statement is that a real strong hint of a pause, and which is what I think should happen. Given the lags in monetary policy.
Well, he's saying that beyond the 50 basis points, which he think is going to be the increase next time, the Fed lingo, the Fed terminology has to reflect a more dovish stance to kind of calm down the market from the panic they're in right now. Interesting.
Given the tightness that we've seen so far, they need to pause to see what actually is going to happen. That would really spark a big rally. But even a strong statement that we have seen good signs about inflation and that most of our increases are behind us, I think could spark a December rally. If not, then it will come in in January, the first meeting of next year.
Oh my goodness, that's super aggressive. So he's thinking the Fed pivot happens either in December or January, and it's going to start off an immediate rally. About the rally, probably. Yeah, the market is so much in fear mode that any good news will definitely do that. That's an aggressive stance. So he's definitely seeing a pivot in the next 2 months. So there you go. If you needed like a credible source to potentially show you an option of a pivot, a credible option of a pivot, there you go. Comment below if you agree or disagree with him. I'm thinking that this whole thing is going to come down to what happens in the rest of the world. I think the U.S. is living in the global market. Prices of everything, even though we have a lot of it and we don't need anybody to buy it from mostly, the problem is it's a global market. Until China stays closed, until Russia and Ukraine are fighting it out, and until we can't find a way to work with OPEC to reduce the prices of energy globally, this is going to be a stretch. I hope he's right. I do, because it's going to be good for everybody if we are, in fact, in a position where we beat inflation. But I'm very, very doubtful if we're there here yet or not. I guess we'll find out. We'll find out. If you need some good positive catalyst, here you go. Comment below if you agree with him, with Professor Siegel, or you think Jim Bullard from St. Louis is right, and this is just the beginning of the pain. Comment below. Let's see what everybody's thinking. I'm curious to see. And I'll see you in the next video.